All right. Hello, everybody. Welcome to the Energy News Beat podcast, Conversations in Energy with Stu Turley. My name's Stu Turley, President and CEO of the Sandstone Group. I've got actually a wonderful conversation today in energy. I have two of my most favorite oil and gas guys out there. I've got Josh Young. He's with CIO Bison. You're the Chief Information Officer over there at Bison Interest. How are you today, Josh?
I'm good. It's a chief investment officer. It's funny because there's so few investment funds, especially in oil and gas these days, that I can see how that would happen. It's nice to be on.
I'm sorry. I went to Oklahoma State University, and we barely learned how to read when I got out of school. So I'll tell you. And then we got David Blackman. I mean, David Blackman is a legend in my mind. David is a Substack author, a Forbes contributing author, and he's also on about 19 other areas around the world. How are you today?
Feels like it sometimes, doesn't it? Yeah. I'm great. It's a wonderful day in Texas.
I'll tell you what, for folks that don't understand, I'll tell you, Josh, I follow you on X as well as LinkedIn. And what is your handle out on X?
I actually just retweeted this, so hopefully we get a few more folks in here. My handle is Josh_Young_1, and I'm probably a little too active on social media, but you can catch me on there.
Well, I'll tell you, I do appreciate it. And today, as we talk about this, we want to talk about, oil and gas is critical for just basically living. I mean, you take a look at fuels, you take a look at commodities, you take a look at modern life, and oil and gas matters. And you take a look at gasoline is 45% of U.S. petroleum, that's an awful lot of it. We're not going to be migrating away from gasoline anytime soon. So I think it's going to be around for a while. And where we're going with this conversation, guys, is over the last few years, I'm really confused, which is normal because I do have an Oklahoma State University on my wall over here, is that it used to be supply and demand. But now we see tankers blowing up in the middle of, the Red Sea. The Houthis and the blowfish are just going nuts over there. And then all of a sudden, nobody even does anything. We sanction Russia. Russia is now the fourth most wealthy per capita country in the world, thanks to sanctions. And then you sit back and kind of go, now OPEC is sitting there and OPEC plus, nobody's adhering to their production quotas. So you sit back and go, is oil and gas or oil supply side? Is it demand side? How do we price this out? And Josh, as the chief investment guy around here, how do you see this?
Oh man, yeah, it's real tough. There's been different sort of modes for the oil market over time. So I have a Crude Volatility bookshelf back here. It's a good book for sort of the history of oil prices and sort of the drivers of oil price. And that one has a framework of, is the oil market controlled? Like, is there an OPEC or a Texas Road Commission or so on controlling incremental supply and therefore dictating price? Or is it not controlled, in which case it's sort of demand driven and much more volatile? And I think what we're experiencing right now, sort of leveraging off of that framework, is we're going from a relatively managed price environment to a demand driven price environment. And I think that's what makes it so complicated, is that no one knows what oil demand is right now. Refiners don't know, producers don't know, gas stations don't know, and consumers and economists definitely don't know. And so, I think that's where you have all these different other tools for price discovery. And ultimately, often, traders have this idea that like the market price is the truth. And the reality is that there's no real truth in the oil market. And it's sort of a constant battle. So the answer is I don't know, and I don't think anyone knows. And that's the reason why.
Well, thanks for that help. I appreciate that.
Hey, no, listen, I'm right there with him. I mean, nobody does know. It's if anybody really knew, we'd all be filthy, stinking rich, and we wouldn't be sitting here on a podcast, right? I mean, if we could predict where the oil markets were going to go for a week, you could become so wealthy you'd never have to think about money again. So it's totally unpredictable. I mean, we had just another oil tanker almost got shot out of the water yesterday, and fortunately, they had some people on board with automatic weapons that shot the missile that was coming at the tanker out of the sky. But we've had two others that have been blown out of the water here in 2 weeks, and I think the price of oil is down by about 6% during that period of time.
Right.
So,
and then we had two over in Singapore catch fire because they were transferring Russian oil from one ship to the other. I mean, you can't buy this kind of entertainment in doping. Spoofing and doping used to be just with the Olympics. Now it's with tankers. Right?
Tankers and presidents, yes.
Oh yeah. Speaking of that, most investors, Josh, have you found, Josh, that under Democrat as an investor in oil and gas, you make more money investing in oil under a Democrat government because of higher oil prices? Is that a fair statement?
People say that based on recent occurrences, but I don't think that's necessarily true. I think it's true for maybe the price for oil, but not necessarily for the valuations of the businesses or the profitability of the businesses. So I think it's sort of more people latched onto that because the people reporting on it are almost all Democrat or further to the left than that. And so with the media organizations very aligned with that, they try to show some reason why it's irrational for people to not agree with them. And their thought is, hey, if it's not profitable for you, therefore you shouldn't do it. And people do have incentives they respond to, but the reality is it's way more complicated. And going back to other sort of test cases, you saw prices go up under Biden and down under Trump, but you also saw them go up under Bush and then down under Obama. And so, or at least once Obama was elected, if you look at sort of the polling, people punish Bush for the crash of 2008, but the reality is that the crash really kicked off in September of 2008, where the polling became very clear that Obama was going to get elected, and the market started to price in the sort of socialization and sort of heavy regulatory framework that was going to come into place. So I would push back on that. And I think the reason that that sort of myth is pushed is because of sort of who's telling it and what their political alignment is.
Oh, David, I'm going to show you this one video here, and I want your opinion on what may happen on this next election thing here.
So, yeah, and starting with what we can do on day one around public lands.
She just said she's banning fracking.
And then there has to be legislation. But yes, and this is something I've taken on in California. I have a history of working on this issue. And to your point, we have to just acknowledge that the residual impact of fracking is enormous in terms of the impact on the health and safety of communities.
What do you think, David?
Well, I mean, she's taken all sorts of radical stances like that. She, right there, as you said in that town hall, she promised to ban fracking nationwide, which, Joe Biden never actually did. Joe Biden only promised to ban it on federal waters. And she also promised in that same interview to ban drilling. Okay. So she's extremely radical. She is so radical and believes so strongly in the Green New Deal that she signed up as a co-sponsor of it and advocated eliminating the Senate filibuster to get it passed. Okay. And the Green New Deal is this ultra radical, basically rejiggering of our entire economy and society under the name of climate change. And it's just the most radical energy policy ever proposed. So yeah, you don't get further to the left on energy policy than Kamala Harris has been. Whether becoming actually the president of the United States would moderate any of that, no one can know. And so I just think you have to take her at her word, and the word we have so far is pretty difficult to digest.
Josh, when you were on with, I believe it was Becky over at MSNBC or the morning show, that was a great interview. there were some great points that you brought out in that interview when she was talking about the oil in I believe it was a merger that was going on that you were discussing on that. If you remember that one, I know you have a child at home and you're not sleeping much.
Well, that one was really tough because I was in New Orleans for the Louisiana Energy Conference, and I found out essentially I would be on TV at the equivalent of, I think it was 5 a.m. New Orleans time.
Right.
And this was the third day of the conference. So there had been 2 evenings of, it's actually really productive to energy conferences. You go drink with the executives and drink with
Yep.
other investors and bankers. I learned all this stuff from these different commercial lenders and transaction folks. And then, have to be up at 5 a.m. So honestly, I did try to rewatch that. I don't love watching video of myself. It sort of it feels too sort of arrogant and off-putting, and so I don't exactly remember what I said, but hopefully.
But you brought up some great points about regulatory issues, and that I believe it was at Hess and the merger that we were talking about. They were such a minuscule pricing. There's no way that they should be looked at for being held up by the SEC, because they're so small. And again, it's the regulatory arm that is frightening and getting more and more prices to consumers that we really have got to look at.
Oh yeah. Yeah, so I think that was the Conoco Marathon deal, and there's just nonsense, right? Like, they were talking about the FTC, and the FTC is investigating that, I believe, right now, and it's just nonsense. The idea that Conoco, which produces around 1% of the world's oil, buying Marathon, which produces about 0.3% or less of the world's oil, is going to somehow affect the price of oil, when OPEC can't affect the price of oil at this point with 30% or so of the world supply. I think it's pretty radical. And then also radical when you look at other markets, where you look at like Nvidia with an overwhelming monopoly essentially on AI relevant chips, and
Right.
TSMC, where like every chip essentially is manufactured by them, and with no government intervention. I think it's just it's very extreme, and that's the sort of thing where I think it's totally misrepresentative to say, hey, these businesses are somehow going to do better under Democratic Party leadership in the U.S. Where, yeah, maybe oil prices might be higher, but it'll be higher because of that sort of illogical, irrational, uneconomic intervention.
Right.
And then you look at California, where Kamala is from, or at least where she held office, and you look at the total energy policy failure there, where they've shut down refiners, they've shut down oil fields. And then they blame the oil companies and the refiners when they have twice the gasoline price, like they had when I was visiting, I think a year or so ago. It was like $6 a gallon or something for gasoline there, versus it was like $2.50 or $3 or something for gasoline here in Houston and in most of the country. So, failed policies have consequences, but not usually to the benefit of the industries that are being punished by those failed policies.
David, you've got one of the best Substacks that's out there. It's the Energy Absurdity of the day. You're at blackmansubstack.com. And
thanks
the energy,
for the pitch there. That's great.
I'm a subscriber. I love your stuff, and I steal every bit of it that I can, because I'm a legend. You're a legend in my mind. But when we sit back and take a look at you brought up the Chevron deference in a very, very big ruling. I see the Biden administration at least for today, they're still going after and trying to shut drilling down.
Yeah, the Chevron deference reversal in that case, the Loper Bright Industries v. somebody. It's a huge decision, and it's going to be a real roadblock if Vice President Harris is elected in November,
Right.
to her trying to enact that agenda, because the main reason, the existence of the Chevron deference as a principle of the judicial system, has been a great enabler of the expansion of the regulatory state in both the
Right.
Obama and Biden regimes. And, with its reversal, now the courts are not obliged to just defer to the lawyers, who are often very ideological people in these agencies and their interpretations of the statutes. And so, trying to put the Green New Deal in place now via the regulatory state is going to be a near impossibility. And you would have to do it through executive orders and through legislation. And unless you have supermajority in the Senate, you're not going to be able to do that either. And
Can I tell a quick story that something happened recently that maybe will make this sort of more tangible? Because a lot of people seem to misunderstand this. I totally agree with you, by the way. It's a very important decision, but it's a federal decision, right? So it doesn't affect sort of state regulation or local. And so I had an experience recently with local regulation, which explains, I think, the problem with the Chevron deference, and hopefully we change that real soon in Texas because there are real issues. So I live in Harris County in Houston, and Harris County is the county in Texas sort of matters a little more, has a little more power than the city on a number of different aspects. They provide policing in many cases, they provide whatever, and they tax your property, which is sort of the main revenue collection mechanism for the state, property taxes, oil taxes, and so on. And so, and then I think sales taxes. And so they sent me an assessment for my house, which was nonsensical. They assessed it way too high. I wish it was that high. And so the problem was that, so I appealed it, and I went to the sort of informal appeal, and they take your testimony and then they show you what they did to come up with their assessment. They only show you after. And so they show I still own the townhouse I bought a few years ago in a sort of development, like gated community of a bunch of townhouses. And so they showed the comp set. First, they showed, hey, we assessed it similar to your neighbors, which is irrelevant because, of course, they just made up the number. So that's not a way to value something. You don't make up your numbers and then use that. You look at recent transactions, or you look at other third parties. You don't just use your own numbers. But then they showed their comp set, and it was like, okay, there was another house in the community. That makes sense. And another one, similar townhouses. And then they showed, these things have like a small amount of land and a structure. And then they showed a single family home that had 5 times as much land, that was half a mile away and was twice the price. And they included it. So it was like 2 normal ones, and there's no recourse. There's nothing you can sue them. Right? It's crazy, crazy expensive. So I'm going towards a formal hearing where maybe they'll change it and maybe not. But that's the problem, right? It's not like a normal process. They just make it up. And they make it so annoying and offensive, and they're rude, and they like change the time on you, and they schedule an arbitrary time to try to like sort of mess with you to make you not show up. And it's all, the whole setup is to just punish you for existing, and then to try to maximize their revenue or whatever from the thing. And so that's not how it's supposed to work. And Chevron sort of had protected that in the federal government for decades. And so, again, hopefully Texas undoes it, but that whole process isn't the court process, right? There's no deference to you. There's a deference to the regulator, and that's wrong. And that's not how the country was formed. And frankly, the revolution in 1776 was on the back of that exact problem, right? It was on taxation without representation, which is sort of this like, bureaucracy, regulatory body thing punishing you without you having any input or your peers having any input. So anyway, that's Chevron as I understand it, and that's my personal experience recently with a sort of non-voted for regulatory body misbehaving in a way that's just obvious, right? Like, I don't think they believe that they should use it, but they only include that information after, so you can't actually contest it, which is just totally not cool and wrong.
Absolutely. Wow. And it's a terrible system in Texas. Anybody who's a homeowner here in Texas knows how onerous it can be to try to file those protests. And you're right. They punish you not just for existing, but also for protesting, right? Yeah. The harder you fight, the harder they push back. It's really a disgusting system here in Texas. But it is, I guess, still a lower tax state than a state like California.
Yeah. Well, when you take a look at the cost of energy for Texas is half of New York and California. So I'm all in on the pricing of that, but we could still save a lot of money on that. Josh, let me ask you this question. You put this out on X the other day, and I absolutely love this because as an investor and you're sitting there, could you explain for our podcast listeners, you've got a pain diagram. Okay, you've got a headache, you got a stomach ache, and you got value investing the entire body, and then commodity investing is the entire wing, I guess.
Yeah, so I never expected to actually have any sort of real following on social media or anything like that. I started getting active because my stuff was getting plagiarized by major sort of news organizations and stuff, which was annoying. So I figured, hey, if I really broadly disseminate it the most possible, maybe I'll get plagiarized less, which sort of has worked, but not really. And I took control of a public company in Canada a number of years ago. Still, some Canadians were very mad at me for that and like sort of offended personally, oddly. It was a good outcome. It was a bad situation for the company, but good outcome for the investors and sort of changed the trajectory. But people are still very, very mad. You'll see these things. They get mad either because I talk about a company they're involved in that's terrible and I share why it's problematic, or because of this sort of legacy stuff. So anyway, so very early on to using social media, I started my Twitter account in like 2009, but like I just didn't use it until roughly 2020. So very early on, oil prices are very, very volatile. And so I shared this Ferris wheel. It was like, hey, what's investing in oil and gas like? And it shows it's like a Ferris wheel. And the person's like, oh, okay, I understand Ferris wheels. So it's like, I'm not done. And it's a Ferris wheel with the thing on fire, the sort of carousel thing that your seat area. And so people didn't really, they understand that, they like it. But I just really wanted to hammer it home. And so on down days, you show sort of the Ferris wheel on fire, just to understand just how terrible it is. And then on up days, you remind yourself of what it's like to be a value investor in commodity equities, which again, like value's out of style, small cap is out of style, out of favor, and then commodities are out of favor. And so if you're in all of that, I mean, the stuff I'm in recently hasn't done so well. It didn't do so well for a number of years, and it did stupidly well. Like suddenly I was brilliant in 2021. And so in 21, I started sharing this thing, which is, look, like this is not easy. It's not meant to be easy. Don't follow me into stuff. If you want to, like, I'll share stuff because I have to or whatever, but like, do your own work and whatever. And so I just tried to hammer this home. For anyone that didn't understand the Ferris wheel on fire, just this is what investing in these small cap things are. And when it's not this, that's the time to sell and stock up so you can buy when you remember just how painful it is.
Hey, back to oil prices for a second. I just got reminded, we talk about how the Houthis shooting the tankers out of the water isn't really impacting the oil price. But one thing that continues to at least temporarily impact oil prices is these EIA inventory draw reports. And we've had another big inventory draw today, 3.7 million barrels, I think it was, domestic crude inventory, and distillates and everything else was down as well. How do we explain that, the market does seem to respond to those inventory reports that I think you tweeted today, Josh, are notoriously unreliable, right? But in a bigger way than they respond to a video of a tanker getting shot out of the water. So how do we explain that from an investor standpoint?
So if you look over the last 40 years, there's really only been one oil geopolitical event that's actually sent oil prices up for more than a couple of days, and that was Russia's invasion of Ukraine. And frankly, even that was sort of a miscue, and you saw oil prices at the end of 2022 down to essentially near where they were at the start of 2022. So it was a very temporary thing. So if you look at how trading works these days and sort of a market sort of price formation is set, a lot of it is set in an increasing amount, not just in terms of dollar amount, but also dollar trading activity on a daily basis, driven by algorithms, by CTAs that are sort of rules driven. And so I think the game is to basically short oil geopolitical risk anytime it pops up and affects the price a little, because it's worked almost every time. And then even when it didn't work, you just doubled down and then tripled down and then you won over a year rather than over a day or two
Yeah.
with the Russia-Ukraine invasion. So I think that's what's happening there in terms of the geopolitical
That
risk.
actually makes a lot of sense.
And I don't know for sure, but I have a lot of friends that do commodity trading, not just sort of like oil and gas businesses or whatever, but that are actually just trading the physical or trading the futures, and that's what they say. And it's sort of this joke that, hey, I mean, the ultimate sort of macabre joke is that the trade, they show the dinosaurs and the comet coming, and the joke is buy stocks. And so it's not just for oil, but that's the joke. And there's some weird truth to it. And that's more profitable over time than if you look at the inverse of that, Bill Ackman getting on TV. Everyone forgets this. They love him for some reason. They forget that he got on TV, and I think it was April of 2020 at like maximum fear, and cried and told everyone to sell as he was covering his shorts and buying giant amounts of stock like that day. Told everyone how scary it was and to sell. And so, you want to do what Ackman did, not what Ackman said. And so, I think and there's some truth to that. And I do think, getting back to like the reality, eventually that breaks.
Right.
And when it breaks, because everyone is sort of trained to fade this stuff, that's part of my view on, I think oil goes to all-time highs. I think it goes ridiculous, parabolic at some point. And so part of what I think is going to feed that are people sort of systematically shorting whatever it is that's driving oil up, whether it's an undersupply, whether it's a geopolitical event, whether it's some sort of combination. And we saw that in 1973, and again in 1979, and again in 2008. So it's not like it hasn't ever happened, and frankly a little bit in 2022, but then it got killed real fast through policy, SPR dumps, and so on. So I think that's what will happen. And it's sort of weird because you can know what's happening right now in the market dynamic and sort of see it and joke about it, but then also know that the more times this happens, it's like crying wolf, but instead of one time, it's like 500 times. And so that really sets up for a real wolf disaster.
And we sit back and we take a look at OPEC and OPEC plus, the loss or the inability for them to control their folks and say, hey, we're going to try to maximize the dollar amount. And then you see the war between the IEA and the OPEC. Who's a better forecaster? I think Saudi Arabia is a little smarter than they are, my personal opinion. But I'm not going to say that. Josh, you put this out the other day. I think that shale production in the U.S. changed the world in energy. And what were you thinking when you put this out?
Well, so I shared this morning. Novi Labs just came out with this. They're worth following. They put out interesting analysis. And my take on this was actually, so what you would see if you look at this and just don't analyze it, you just look at superficially, it shows that shale well productivity is higher. And this is different than the narrative and different than what you'd expect given how many years shale fields have been under development on the oil side. And so I think it's worth thinking about why this is happening. And is it happening for what it looks like, which is that shale wells are getting better? Maybe they're finding better fields. Maybe the producers just getting so much better at completing wells that they're driving down the break-even price. And actually, I think this is it's like the exception that proves the rule. So this is happening for three reasons I shared on social media. So one, oil prices are down relative to where they were a couple of years ago and volatile. So operators are high grading their positions. So they're only drilling their best locations for the most part, much more so than 2023 or 2022. In 22, there was a lot of impetus to go drill exploratory stuff to add inventory because at $120 or $130 oil and at way higher natural gas prices, which really drives the economics for shale, you're rewarded for that. You're punished for that now. So better spots. They're drilling longer laterals, which helps production per well, but not per foot. So, and then that third category, that per foot thing, is important because the productivity is increasing per foot. The other thing that's driving it that people I think don't really understand, it's not talked about enough, I think, on shale, is that they're actually upspacing the wells. And so, and also there's more parent wells and fewer child wells that have gotten developed so far. And actually Novi Lab shared this too when they share the analysis. There's the chart, which is very bearish on the face of it, and then there's the detail, which is actually really interesting and nuanced, but also very, very bullish, where when you use more land per well, both because you're using a longer lateral and because you're fitting fewer wells per acre of productive land, and you're drilling your very best wells and you're only getting a little more production, even though you're using more land and drilling longer wells that are way more expensive, and you're only getting a little more production per foot, that I think you're getting close to sort of that peak exhaustion point. And then also you're using way fewer rigs. So when you add more rigs, the expectation, I think, from this would be that your per well, per foot productivity is going to be falling, and maybe even your per well productivity will fall. And that's sort of what you look for. I think it looked like that was happening in 2022. I thought that. I was wrong. And it will happen. And I think I jumped the gun.
Sooner or later, it's got
like it was happening from the data. This is important, I think, because this actually looks bearish, but it maybe is more bullish than the stuff that we saw in 2022. And yet oil is at 77 right now or whatever, and not, 120.
Yeah.
What do you think?
Years ago when Harold Hamm was speaking in Denver at a intercom event, I was sitting there kind of looking around, and he says, we're at I think 1,200 rigs or something at the time. And he goes, we're going to be down to 700 and we'll be at 400 and be happy at 400 someday. Everybody in the room fell out of their chair. They looked like Fred Sanford. I mean, he was grabbing their chest and they're going to die. But we sit back, and back then, Josh, you could be at $40 oil and still make money. But the supply chain costs for my E&P operators, when we're evaluating deals and costs and drilling, pipe is so expensive. You take a look at all the raw costs for drilling. We can't go backwards to that time in past for making money at $40 oil. Do you see us kind of hovering around in this area, guys?
Well, I think some companies in the Permian still claim to be profitable at $40 in some of their prospects, and maybe that's true. But I wouldn't think most of them are, right? I mean, it's hard to believe.
I've looked at some bills on drilling. Holy smoke!
Well, I mean, but so much of it depends on how your economies of scale and how contiguous your acreage is, and your ability to drill those long laterals and finance those projects. And companies can save an awful lot of money, and that's why there's been such this push over the past 5 years to get bigger and bigger and bigger. That's why ExxonMobil wanted to buy Pioneer and create this, by far the biggest producer now in the Midland Basin. And it's why Diamondback wanted to do the big acquisition, and et cetera, et cetera. And so those companies that are able to take advantage of those economies of scale are profitable at lower prices. I still, though, when I see somebody claiming they're profitable at 40, I have to wonder what the mechanics of that are. Even
if I had hair, I'd scratch it.
Yeah, I mean, the price of doubled in 5 years at least.
Right.
And it's just, supply chain difficulties have calmed down somewhat, but they're still there, and there's still a lot of challenges. And so to me, if this price can't go much below 60 without causing a really big displacement in the oil industry.
So this reminds me, my mom, I think I was in high school, maybe college. My mom got me this T-shirt that says humble, but still the best.
Yeah.
And
I remember those shirts.
I'll break it out when oil prices go to all-time highs. I'll get on maybe we can reprise this, and I'll wear the humble but still the best T-shirt. So I think it's really interesting to see what's happening with natural gas right now. I've shared a lot on social media, probably too much, and I don't think it's very popular to talk about this because a lot of the jobs in oil and gas are in oil field services, and people I think feel attacked when you share that, hey, maybe people should be using fewer services currently. But wells in the Haynesville are costing, let's say, $15 million plus or minus a little right now. And when you look at the actual price that you can sell your gas for today, Henry Hub, it looked like, was around $2.10. $2.10 an MCF right now. After gathering and processing and the local basis price, so net of those three things, apparently some operators, even leading operators, are getting about 40 cents per MCF for their gas. So the joke is, hey, they make it up on volume, but there's no volume that a Haynesville well can produce that makes up for that 40 cent sort of profit. Because, if you have to spend $15 million, I mean, you need the world's biggest gas wells, period. And then the problem is that they don't sustain, they decline hyperbolically. And so you just don't ever make your money back at that price. And yet there are 40 rigs running right now in the Haynesville. And yes, some are hedged and some are contracted and some are whatever, but it's actually up from where it was a month or two ago. And so when you look at the failure of the industry to behave appropriately in response to price signals on the gas side, it is not promising, I think, in terms of the long-term health of the industry. And I think it's concerning. I think oil may go, I think when it does go to all-time highs, I think you may see just the biggest boom. And this is part of why I'm rooting for Republican versus Democrat for the industry's sake. I think you may see a giant employment boom and a giant activity boom. And it'll be amazing for the drillers and less so for the E&Ps, the companies that sort of own it and are paying for it. Because I think you're going to see what you're seeing in gas with oil. I think it'll be a exciting boom, and very, valuations should rise on assets, and maybe the equities will do well or not. I'm not sure, but it's going to be amazing for OFS. But it's crazy when you look at the specific economics on this gas production. And the biggest single thing, it's not just the drilling, it's the choice. These wells are very easy to constrain. And so if you're producing, let's say, 2 BCF a day, you could choose, and let's say you have a BCF a day hedged at $3. So you could just cut off half your production, constrain all of your wells by 50%. You'd actually increase your ultimate recoveries and preserve the capital you spent on that production for a future time when you can sell, and you can even sell forward that gas a year from now or so on. And so these operators are not doing that. And that's a really big deal. They're destroying their shareholders' money. They're doing it for various reasons. Some, I think, political, some whatever. They want to keep their jobs or some other stuff. Anyway, I think it's really worth paying attention to that and thinking about it, because I think it's relevant for sort of the trajectory for oil in the future. Not right now, but it's good to know sort of what the nature of the industry and the nature of the executives and boards are. And I think the gas producers are telling us what the real nature of the industry is, which is, I think, there's the bumper sticker, "Dear God, give me another oil boom. I promise not to blow it this time." So those promises are in vain, unfortunately.
Well, Josh, David and I have talked. I think that the ESG did do a good thing for the oil and gas industry, in that they did exactly that. Oh Lord, let me get past this next this oil boom. They do give back. And they are giving back their money and buying back shares. The oil and gas investments that I'm in make all the difference in the world. The ESG, our great oil and gas operators in the United States, do so much better than our counterparts around the world, that we do need I think we need everything that we can. And with AI, Josh and David, AI is ruined net zero and the energy transition, because we need nuclear and we need natural gas now more than we need it for a more stable grid. That's my unprofessional opinion.
Yeah, but you're going to have a stronger gas price eventually, or this drilling is going to have to stop. They can't just continue to cash flow this gas forever. We did that during the 90s.
Josh is over there going, yeah.
In the San Juan Basin. Just take y'all back 30 years.
More shares and drilling more wells, and so are some of the other guys. So I don't know. It's magic. It turns out if you also own alternative energy stuff and collect billions in subsidies from the Green New Deal and IRA and stuff, maybe you have some other economic incentives.
Yeah, but how many of those companies do that?
That whole set.
But how many of those companies that stuff that are producing that gas. Does Chesapeake own that stuff? I mean, there's these companies that are out there doing that right now are not in a great position unless the gas price firms up. So I just, it's hard to see how that continues. It's just not a sustainable model.
But how do you get the gas price to firm up if you have producers willing to produce their commodity and then drill more of it way below their break even? I mean, again, it's easy
You
to
have
pick
to
up.
have a big increase in demand, right?
Yeah.
And that comes from LNG exports, and it comes from power generation. But that's not coming fast enough. And of course the government's got a moratorium on permitting right now on LNG. So
You see, that's where I'd push back on the ESG aspect, where I think in an alternative universe, Trump won in 2020 instead of Biden. I think you still see oil prices go way higher and gas prices go way higher, but I think it's way more sustainable because you don't have these uneconomic, sort of energy inefficient rules and regulations around, what is it, the alternative energy sort of mandates and the EV mandates and the fuel, which a lot of the companies either cheat on or they like force whatever. So instead of that inefficient sort of misallocation of capital, instead of borrowing money to waste it on this stuff, you'd have money spent on sort of more rational things, which is good for the economy and good for everyone's wealth. But then you'd also have more LNG facilities, more pipelines, more chemical plants, and so on. So I'm not sure that it's true that this has actually been truly good for the industry. Or even for prices. I think it just sort of seems like that. And again, there's this narrative that is very comfortable for those telling the narrative or telling that story to tell.
Well, I had a great friend in the industry named Obie O'Brien. He was with Apache Corporation, great guy. And his favorite saying was, every time prices got strong, his favorite saying was, you can always count on the oil and gas industry to drill itself out of a state of prosperity. And so far, I think what we can say for the current management teams at these big companies that are the shale producers is they haven't done that yet. And maybe they won't. Who knows?
On the oil side, on the gas side, I would argue
on the
that
gas side,
So what do you see coming around the corner, Josh? Do you see us? We have a question here that came in from Messy Times. How much momentum do you think we're making post Chevron to a system of true accountability? That's an interesting question. When you take a look at the Biden administration, there were roughly 4 lawsuits that were filed and won almost immediately by oil companies and or interested parties. And then all of a sudden, the Biden administration banned another gigantic swath through Alaska, doubling down on stupid. So that's an interesting point. What do you guys see coming around the corner?
Well, I mean, I think it's going to take years for that all to work its way through the system. It's a matter of people and companies and states that have standing in these controversies to file the suits and for them to work their way back up to the Supreme Court. And that'll take years. But within 5 years, I think we're going to see a pretty big change in the ability of agencies like the Fish and Wildlife Service or the EPA to make these crazy decisions they've been making in recent years.
Well, I tell you, with President Trump going drill, baby, drill, and you have the presumptive nominee for the Democrats saying, I'm banning fracking. I see a holy cow Batman, either low cost energy or very, very high cost energy. So what do you see coming around the corner, Josh?
Yeah, again, I don't know how much either of them are really going to sort of change the commodity prices or the equity valuations that much. Maybe you end up with higher oil under Kamala Harris, but less profitability for the businesses and lower valuations, or lower oil prices incrementally under Trump, but more activity. So I'm not sure I understand the market is treating it like that as sort of a volatility factor, but I actually don't know how, and I agree with David, it's going to take a number of years for the Chevron issue to actually get sort of resolved. I think what matters more is, at least from an election perspective, the deregulation that happened under Trump administration 1. And if that gets repeated, if Trump wins, then that would be very good for profitability and also very good for economic activity, which would be good for oil and gas demand and therefore prices. I think there's a real risk of sort of further supply disruption. And I think so far it's been very well sort of
in the Middle East.
Yeah, in the Middle East. Yeah. Sorry, not in the U.S.
Right.
And it's been very well sort of choreographed and controlled. But I think as we get closer to this election, you have various groups that have very strong interests in the election of one party or another in the U.S. And I think there's this view that higher gasoline prices, more inflation, which higher gasoline prices and oil prices are tied to consumers' feeling of well-being, even if it's not directly tied to economic activity. People feel poorer if they have to go pay $6 a gallon for gas instead of $3 a gallon for gas. So
we're coming up on the last few minutes here, guys. And you just worked me up, Josh. Thank you very much. I appreciate that very much. The SPR. The Biden administration has totally wiped out the SPR, and then they've not only wiped out the gasoline, they wiped out the Northeastern gasoline strategic reserve, and they're selling it off and closing it.
Don't worry, Stu. It's not like there's an active war in the Middle East right now, and certainly don't worry. There's no tankers getting shot at or blown up. Don't worry. It's not like Saudi and Russian exports just completely fell off so far in July. It's not like Russia and Iraq and I think it's also UAE that overproduced, have just agreed and reaffirmed that they're going to underproduce to catch up in the second half of the year. Don't worry, Stu. It's fine. We're going to be okay.
All right. Josh, we're going to end this here in about the last thing here, but this is how I feel that oil trading is going on right now. And as we sit here and take a look at this, I feel like something is just going to just beat the snot out of me as I'm driving down the road so fast. Somebody's going to open a door and I'm going to end up in the ditch. I mean, either this is a good analogy for what's happening with the political situation or oil and gas drilling. I have no idea on either.
That's how fast the news cycle changes 72 times a day.
Oh, I've never seen anything like it, guys.
It's mesmerizing. So I guess on that note, so I invest in oil and gas equities. And I think the equities, especially on the small cap side, especially the sort of mixed producers that produce some oil, some gas, some NGLs, they're hated. And there's almost no volume in the stocks. Many of them are near their 52-week lows. Some of them are near their multi-year lows. I know it sounds surprising because Exxon and Chevron and so on have done very, very well. And so I think that you never really have a recession priced in fully, but I think you have some amount of that priced in already into these equities that are not driven by sort of passive index fund flows. And so I think you have that already. And so to me, hey, if it's 50% or 70% or something priced in already to the downside, I don't know, to me, it's very, very compelling. I'm really excited to deploy capital where I'm able to. And the valuations that I'm getting are, I think, reflective of the consensus view, I think, on oil, that everyone's sort of expecting this thing to happen, a recession, oil price crash, whatever. And if that doesn't happen, just these valuations are way too low. On the small side especially, but even the large caps are sort of too low and they should resolve higher. And then if something happens like that video, let's say like to the right, it's like, the wrong tanker blows up and oil doubles and whatever, or to the left, big recession and oil prices crash. Well, if you end up on the right and you're in some of these small cap things, I feel like it could be similar to early 2008, where you had these moves in these less liquid, smaller cap oil equities that were amazing. I mean, there were stocks that were up 10x relative to their market cap over a 6-month period in 2008 on the oil side. And in some cases, there were stocks that traded like GameStop, like 3 times, 4 times, or AMC or whatever, these like meme type stocks. and it wasn't even that, relative to the price of oil at the time, 140, 130, whatever. These weren't even mispriced relative to their fundamentals. They just, got people's attention. So I think there's a real shot at that sort of repricing. And to me, it's exciting because everyone's so focused on recession, so focused on concerns, and then on these small caps, so focused on there's illiquidity and the stock price is down and the valuation's down. Therefore, it's bad, evil, whatever. And to me, that's like a real fun, exciting spot to be in the market. So I think it's funny because everyone feels like that, and when everyone feels like that, they're scared. They feel like it's very volatile. Often, that's a good time to be to face into the storm, like we say.
Well, Josh, as we close you out, what is your handle again on Twitter?
Yeah, sure. Josh_Young_1, or you can find me on bisoninterest.com. We put out a monthly note most of the time. And I think people, we try to cover what we're seeing in the oil markets. And if people are interested, they're welcome to sign up.
And for our podcast listeners out there, he's got a book of Fossil Fuel by, by Alex Epstein. I've interviewed Alex twice, and that is a heck of a book you've got sitting back there.
It's right next to Unconventional Success by the old chief investment officer of David Swenson of Yale. And so it's sort of interesting here. I'll try to move my head so you can see the one right to the next right next to it. And so you really want to, I think, sort of pair the, hey, is there an ESG issue here or whatever with the, hey, how do you manage these things over time and allocate in a way that's rational and that allows you, if you zig when everyone else is zagging or whatever the sort of your chosen aphorism, I think it'd be really helpful over the longer term, like what David Swenson said.
And hey, if you move your head a little further, we can see the book Texas Big Rich. Yeah. Which is what we all want to become, right? That's a great book.
There you go.
Option strategies, crude volatility. Let's see what else I got up there. Peter Lynch book or two. It's a fun bookshelf. I've read all those like twice, and then I have my other sort of functioning bookshelves where I go through and am actively reading them. So it's sort of been, people have talked about how it's been static, but these are books I can't exactly tell you like what's written on what page, but been through them enough that I think I've mastered them enough to be able to have a conversation about them, and therefore they can go up on a bookshelf.
I love Alex Epstein. He is a cool cat. I love both of my conversations with him. David, we find you on david.blackman.substack.com. And where else can people run you down? That's probably the best place.
If you go there, you can find everything else I do. I link everything there. So it's all in one central space.
Well, thank you both. I had such a great time. Thank you guys so much. And I hope to have this again, because coming around the corner, we had Kim Jong-un meet with Putin, and also Putin met with South Korea, and you're about to see some pipelines going from Russia through North Korea to South Korea and then over to Japan. Now, you heard it here second. So with that, let's have some fun. We'll see you guys next time.
Thanks a lot.
We're ending